Nirav dives deeper into the financial performance for the period. Over to you, Amrit.
Thank you, Manish, and hello everyone. I'm delighted to be here and to be part of Jagsonpal's exciting growth journey. Having spent close to 3 decades in the pharma industry across organizations like Wockhardt, Zydus, and Torrent, and most recently as CEO at Akums, I've seen how strong brands, agile teams, and focused execution can truly transform businesses from good to great. At Jagsonpal, I see a strong foundation, trusted brands, deep market relationships, and growing presence across the key therapeutic areas. This opportunity ahead lies in scaling this platform with sharper execution, marketing excellence, and operational agility to unlock the company's full potential. I look forward to working closely with the team to accelerate this momentum, and from next time onwards, you will be seeing and hearing a lot more from me as we take this journey together. Now, I request Nirav, our CFO, to please take us through the financials for the quarter and the half year. Thank you so much.
Hi, everyone, and thank you, Amrut, and thank you, Manish, for your introduction. I would like to take a moment to express my gratitude to the entire Jagsonpal family for the warm welcome. As we move forward together, I'm confident that we will continue to uphold Jagsonpal's long-standing values of trust, quality, and excellence in everything we do. So, coming on to the financials, the second quarter performance remained relatively steady, with the revenue at INR 74.5 crore, reflecting a temporary moderation due to the GST transition. EBITDA for the quarter stood at INR 18.1 crore with a margin of 24.3%. Our PAT grew up by 10% year-on-year to INR 12.6 crore with a margin of close to 17%, up by 150 basis, underscoring the company's operational resilience and brand strength. For H1 FY26, the performance remained robust with revenue up by 10% year-on-year to INR 150 crores. EBITDA growing up by close to 9% year-on-year to INR 33.8 crores with a margin of 22.5% and PAT leading to INR 23.4 crores, posting a growth of 39% year-on-year with a margin of close to 16%, up by 320 basis. As already mentioned by Manish, we paid out the dividend of INR 16.7 crores in this quarter, reaffirming our commitment to deliver shareholder value. Even after the payout, we continue to maintain a strong cash position of INR 160.4 crores on our books. As we move ahead, our focus remains on sustaining profitable growth with prudent financial management, efficient capital allocation, and continued value creation for all stakeholders. That was it from our side, and we shall now open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a while the question queue assembles. The first question is from the line of Sejal Kapoor from Anti-Fragile Thinking. Please go ahead.
Yeah, thanks for the opportunity. A warm welcome to Amrit and Nirav. We now have a multi-engine governance and look forward to significant improvement in our performance. Today I've got 3 questions. First one is, there are 2 clear headwinds for our industry. One is trade generics and the other one is generic generics or Jan Aushadhi. Both these segments are growing much faster than branded generics. Why will this not impact the terminal value of all branded generics companies in India? That's my first question. Thank you.
Yeah. So, Sajal, I'll give it a shot because this obviously is a matter of great debate and discussion. So we'll keep it short in this conversation and we can have a separate conversation again later on. I believe India is not one market but multiple markets. And so there is a place for trade generics The customer base for trade generics is different, so also for Jan Aushadhi. I mean, so far nobody in India expected that likes of Monjura or Keytruda can become such big brands, which are patented products priced at par with global prices. So you have to see it, India is a multiple market. With due respect to trade generics and Jan Aushadhi, the entire aspect of quality needs to be looked into. As I also mentioned in my opening remarks, that's one area India needs to really focus on. Made in India for India. We are very good in manufacturing for outside India, but unfortunately, we do not have similar standards for India. And this is where I do believe more regulatory oversight will come in, and that will have its own impact on the price differential between trade generics and or Jan Aushadhi scheme versus the branded generics. So I don't have the right answer for you. I believe trade generics and Jan Aushadhi will stay. They will grow faster because we have a lot of bottom of pyramid to cover. But the growth of the branded generics, which is 7.5% to 8%, will not go away. That market is growing. That market will continue to grow. And as Indians aspire for better quality of life, so will people move from trade generics and Jan Aushadhi to branded generics. Does that partly answer you?
Yeah. That's helpful, Manish. We can take it offline and have a detailed conversation. And in the interest of the time, Manish, I'm sure you, Amrit, and Nirav as well, we appreciate the fact that there are only two drivers to create value in any business. One is the PAT growth and converting majority of that PAT into cash flows. And the second one is having a good enough ROCE. 20% plus, in my definition, is a good enough ROCE. So ROCE-wise, we are well ahead of where we should be, even including the cash on books. Excluding the cash, our ROCE is in a different orbit altogether. The challenge for our business is clearly the PAT growth. We are converting all of the PAT into operating cash flow, so that's not a problem. Now, if I look at the industry, Manish, Torrent Pharma bought many companies and integrated them successfully. And to my knowledge, neither Curatio nor JB Pharma acquisitions were bought at a low price to sales. Both were premium acquisitions. And there were many who criticized Torrent Pharma for paying top dollars for those acquisitions. But we have seen, how good their execution is in buying good quality assets, paying good money for those assets, and then integrating them. Now, given the fact that our cash is 160 crores as on today, and this will only increase quarter over quarter, do you think we should be a little more aggressive in our inorganic activities?
Right, and maybe there may be some disconnect here as well between us. Clearly, we need to be more aggressive. However, while I fully appreciate Torrent's capability in integration management, I don't think we are, as an organization, that capable or mature. Okay, and I don't think Torrent's capability has been replicated by anybody else in this country. So it is kudos to Torrent on the way they have created value out of expensive acquisitions. I will definitely expect Jagsonpal to be more aggressive, but certainly it is not feasible for us to be as aggressive as Torrent in terms of the value that they pay. Because we have to also bear in mind, we cannot afford a big mistake. Unlike Torrent and all, whose scale is so different now, that a small mistake will not cost them the company. In our case, we are not big enough to take a big mistake. Does that answer?
Yeah.
Well,
yeah. Finally,
sorry, one second. But you will see us a little more aggressive in this regard compared to what we have been in the past.
Sure. Look forward to that, Manish. And finally, in the interest of the time, what is the near-term plan for our per capita or MR productivity? Because I think that's one variable, and I know you have spoken a lot about this. You acknowledge the fact that our MR productivity is today way below where it should be for the kind of business Jagsonpal Pharma is. I know Amrit is joined the team, so now we have a double engine Sarkar, and hopefully, we will work on that metric of per capita or MR productivity. How, what should be the reasonable expectations from our side as a shareholder that, look, this is the kind of road ahead for MR productivity, and how can we track the performance on that metric, please?
So I'll give you a little of my perspective as a equal shareholder as well, and I'll have Amrit dive in further in this. But see, this is an area of weakness and also strength in a way for Jagsonpal. Our profitability is where it is in spite of low MR productivity. So therefore, as the sales grow faster than the marketplace, the accretive value creation or profitability impact will be much higher for us vis-a-vis growth which would have come from enhanced MR numbers. So that's the way I look at it. For us, the fixed costs are already there. We are working on various initiatives to increase our MR productivity. I must admit that so far we have not been able to display outcomes in that, and I believe Amrit's joining us will give us that last missing link that we are kind of losing out in terms of getting it right. Amrit, would you like to add anything on this?
Yes, thank you, Manishji, and thank you, Sajal, for asking this question, and I did expect this question to come. Suffices to say that you have to look at it from two lenses. One is in terms of our penetration for the brand or the portfolio that we have. Our portfolio mix is such wherein we have some of the legacy brands which are overweight as far as our overall revenue volume is considered. And therefore, having the MRs at the right places is important because these are mostly Class B and Class C town products. And having said that, we are working on the same. And I think in the recent past, you would have possibly seen that the new product contribution is increasing. So we are looking at, fine balancing, one, the legacy brands or what we call them as volume contributors to continue contributing while increasing the new product portfolio, which will possibly drive our growth because they are into high growth segment molecules. I hope this answers partly your question.
Yeah. Thank you, Amrit and Manish. I wish you all the very best. Thank you.
Thank you so much.
Thank you, sir. Participants, anyone who wishes to ask a question may press star and one on their touchtone telephone. The next question is from the line of Dipesh J. Sancheti from Mania Finance. Please go ahead.
Hi, am I audible?
Yes, sir, you're audible.
Yeah. Can you share the growth rates of your top 5 brands in Q2, Y-on-Y as well as Q-on-Q? And how many of your brands are now in that 50 crore club or expected to reach that by FY26, end of FY26?
So our growth rate is, as you see, the overall performance is flat for the quarter. So certainly the key brands have also not grown much. So it's all between 3 and 4%. Some brands have grown 3 and 4%, and some brands have been flattish in the top 5 brands. So that's the broad view, because that's what determines the eventual growth rate of the company for us. That is part 1 of your question. As far as our 50 crore brand is concerned, we currently only have 1 brand in that, which is Indocap group of products. And right now, that's the only one which is in that range. It's in the early 50s only. I don't foresee any other brand right now in that range, though we have multiple brands in the 30 to 40 crore range. So they'll take some time to get into that 50 crore club.
Okay. So are any brands showing any early signs of maturity or a slowdown? And how are you refreshing them? Are you extension of lines or maybe dosage forms or geographical expansions?
Yeah. So some work like Indocap, which is the largest brand, we just launched Indocap P about 6 months back, which is combination of indomethacin and paracetamol. So there are multiple initiatives that we are undertaking to refresh some of these legacy brands, as Amrit mentioned. So the key is for them to grow a little faster than what it has been doing, as also, of course, the new products to become more successful than what we have been so far demonstrating. So these are the two growth levers really that will drive a faster growth going forward.
So going ahead, what will be the growth drivers for the company? Because this quarter was flat. For FY26, what will be the growth drivers?
So if you look at our deck, I have consciously, because so far I was driving the strategy alone. Amrit has been a great welcome addition to the company. Allow us a couple of weeks for Amrit to settle down, because I don't want to impose or him to let him play a very important role in rebuilding or refining the strategy going forward. So we will come back to you with a more aspirational growth plans going forward in a couple of weeks.
Great, sir, because we are long-term investors, so it's okay. I mean, couple of weeks, couple of quarters also is okay, but, the growth trajectory, if it is in line, we'll be happy to, enjoy the entire ride with you. Just one more question. If you can give any guidance, particular guidance, especially on your ROE numbers, if you can, will it be maintained at around 18? I mean, right now it's around 18.6 at 19. Will it be still this, or will it go to the mid-20s or something going ahead? Now, and I'm talking about this for at least about FY27, FY28. And if Amrit also can just, add in what would be his targets?
Yeah. So I'll take first part first, and then Amrit can add on. So, and this is also going to partly impact what will be kind of responding to Sajal's question as well. So this is a fine blend you have to carry. Okay, because any acquisition will tend to pull down your ROC. There is no way you can do a deal at 20% ROC in this country, not even at 5% to begin with, because 20 times EBITDA is the minimum expectation in our country. So on our own, our ROC will continue to improve. It will not only cross 20%, but maybe much higher in a couple of years. Having said that, we also need to balance our growth or use the cash for certain strategic inorganic strategies that will always push down the blended ROC to begin with. So all in all, our aspiration is to stay 20% plus in a blended way, but there will be periods of dragging this down whenever there is a meaningful acquisition. Amrit, would you like to add?
Yeah. So as guided by Manishji, I think we'll be looking at that higher double digit in terms of growth. But coming to your second part of the question in terms of brands, we do see some green shoots in the new products that had been launched in the past, and we are also looking at the product life cycle management, some of the power brands or what we call them as a pillar brand, which contribute heavily. So we are looking at that product life cycle management, and which hopefully will translate into much higher yields per MR. So it will answer both the question in terms of productivity as well as profitability for us.
Great. All the very best, sir. Yeah, it does. And all the very best, and hope to see your next growth plans soon in the couple of weeks, as you had just mentioned. Thank you so much.
Sure. Thank you.
Thank you, sir. Participants who wish to ask a question may press star and 1 on the touchtone telephone. The next question is from the line of Shivnil Giri from Centrum PMS. Please go ahead.
Hello. Hi, thank you for taking my question, sir. I just wanted to understand this one part about your strategy that you, in your presentation, you mentioned, and you mentioned this before, that you'll focus only on subchronic therapies. So, just wanted to understand why this is specifically the case that you picked this category to be in, and would this be restrictive in terms of growth over a longer period, in terms of adding new brands, since not every year you would be able to make an acquisition of brands or portfolio? Just that one question. Thank you.
So I'll address it in my way, and then Amrit can add his comments to it. So see, every company has a legacy and its own strength. And this company historically has been strong in subchronic segments. So that is what we believe we can further. The reason for avoiding chronic segment was to begin with, or to start a chronic segment business today is not very easy. It's an overcrowded market. It is where there is a lot of, or there is a fair bit of doctor gratification involved, and that's not a business model we can or we want to pursue. So that has been the fundamental reason of leveraging your strengths rather than focusing on or getting into areas of weakness. Having said that, inorganic strategy is where we are open to doing things which are outside of what we are doing today. So even if we were to get into chronic segment, I believe rather than starting from zero, it will be through an inorganic means rather than organic. Shivani, does that answer?
Yes.
So it's not that we are wedded to subchronic segments, but it's just that our current strength lies in that, and we find it we still have plenty to do within that segment to look outside.
Understood.
Yep.
And in terms of acquisition size, what would be the cap or the ideal size that you would be looking for in terms of acquiring a company or a portfolio of brands?
So I don't think there is any, obviously we can't do the big deals that Torrent can do. But fundamentally, you look at us as in a three-way acquisition funding. One is obviously we have 150 odd crores of cash, and we generate about 15 crores every quarter, plus or minus here and there. So that's the powder that we have, gunpowder we already have. We also have a reasonable ability to leverage our balance sheet. And third, if needed, we are backed by shareholders who are willing to put in more money and or even using equity as a gunpowder. So in that sense, I think we have fair bit of meat available for us to fund acquisition. Having said that, obviously we can't do things that likes of Torrent does.
Understood, sir. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Amit Agicha from HG Hava. Please go ahead.
Yeah, good afternoon, sir. Manish ji, thank you for letting me answer the question, and welcome, sir, Amrit ji and Nirav ji. My question was connected to how much of the 10% H1 revenue growth has come from volume or pricing and new products?
I don't have an answer upfront for readily available. Can we get back to you, Amit?
Yes, sure. And sir, the basic revenue guidance for FY26 for the second half.
So this is something, as I mentioned, so we do expect growth in second half as well. So generally speaking, we are targeting about 10% growth overall as an organization in the medium term. I'm talking of this year, with accelerated growth thereafter, but allow us a couple of weeks to give you a better guidance for the future. But for the rest of the year, you can consider about a 10% growth.
Thank you, sir. I appreciate answering my question. All the best for the future.
Yeah, thanks.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Dia from Sapphire Capital. Please go ahead.
Hello, sir. Thank you for taking my question. So I just wanted to ask if you have any planned launches for the rest of the year.
We definitely have plans, but I think till we launch, we don't want it to be kind of communicating in an investor call. So definitely we'll have plans for launch in the rest of the year, new products. But as and when we launch, we will make it public.
And any revenue guidance for the rest of the year?
I think I just did that in the previous speaker's question, Amit's question, that we are kind of broadly guiding towards a double-digit growth, low double-digit growth for the rest of the year. Market is definitely tough, so I'm not assuring this will happen and all. We would love to go there, but yes, all efforts are to achieve a low double-digit growth for the rest of the year.
All right, sir. Thank you.
Thank you, ma'am. Participants who wish to ask a question may press star and 1 on the touchtone telephone. The next question is from the line of Murtaza from Pinpoint Capital. Please go ahead.
Hi, good afternoon, everyone. Thank you for taking my question and for the opportunity. I had a few questions regarding GST and the new regime. And so basically, I have quick 3 questions on it. First of all, has the recent GST 2.0 made any impact? Has it impacted our cost of goods and or either our margin profile in Q2?
Yeah. So, as you would know that in pharma, the GST has moved from 12 and 18% respectively, 12% for drug products and 18% for nutraceuticals to 5% flat now. So, all in all, the MRPs of the products have come down. As a company, it has no impact because it's a flow-through or it's a pass-through. Our inputs, we have an inverted GST structure now in the industry because many of our inputs are at 18%, especially APIs, while our output is at 5%. But given the gross margin in this industry, that is not going to make any impact per se, given that GST credit is available. So, it has no impact per se. Having said that, the minor impact that we had in Q2 was on account of additional 1% discount that we gave for advance sales for September related products, because that, if you recollect, I mentioned in my opening remarks, most of the industry, between industry leaders and AICOD, the final agreement was a 30-day additional credit and or 1% additional discount for sales made in September to compensate them for the higher GST products that they were carrying. So for the sales made in September, we ended up giving 1% upfront discount for advance payers.
Okay, this helps. The second question I have is, are there any supply chain inefficiencies that have increased the logistic cost or working capital cost?
Coming from GST or otherwise?
Otherwise.
No, GST has obviously no impact. Otherwise, yeah, of course, cost-wise there's no impact, but you would realize that last quarter has been period of disturbances, prolonged monsoon in certain parts, Punjab going underwater, Assam had double whammy, including Zubin Garg incident when almost 15 days that state was shut. So these were the logistical or business challenges that I think entire industry or entire country was facing, but nothing coming out of GST or otherwise.
Okay. And one final question I had, there has been a slight uptick in the margin. So does this anyway relate to the tax impact or is it just core operating efficiency?
Yeah, it's only on core operating efficiency and product mix. That will determine. I don't think we are getting any benefit or adverse impact of anything outside our business.
Okay. These were my questions. Thank you for taking them. Thank you.
Thank you, Murtaza.
Thank you. Participants who wish to ask a question may press star and 1 on the touchtone telephone. The next question is from the line of Athar Syed from Smart Sync Services. Please go ahead. Sir, requesting you to please unmute your mic. Sir Athar Syed, requesting you to please unmute. Yes, sir, you're audible.
Yeah. So I have some questions. Yeah. So my first question is related to this, sir. What is our market share in this gynec segment and other segment as well? Like, what is our current market share that you hold in the market?
I don't think we can even measure Jagsonpal in terms of market share because we are a very tiny player overall in that context. But having said that, in the markets we are present in gynae area, we are the 8th ranked company in this country. So market share data I don't have readily because it is in decimals. But as I said, within the gynae segment and the CVMs that we are present in, we are the 8th largest company, which makes us meaningful in that space.
Okay. And sir, what is this intangible asset that we have, like, and what is the reason it declined from 89 crore to 81 crore in 1 year? So can you please explain what is this intangible asset and what is the reason for some decline in intangible asset?
Yeah. Since Nirav is new, I am taking this time, but obviously going forward, Nirav will be answering. This intangibles got created because of acquisition of Yash Pharma's domestic or India business. So which was about a 95 crore acquisition. Out of that, 88 or 89 got converted into intangibles. These intangibles are depreciated every year, and therefore you'll see a depreciation line in our books as also a reduction in these intangibles every year.
Okay, sir. And last question is, how many MR do we have right now and our MR attrition rate?
So we have 1,000 odd MRs in the organization between the 4 divisions that we operate in. The attrition rate would be in the region of 30%.
Okay, sir. Thank you. Thank you so much.
Thank you, Arthur.
Thank you. Participants who wish to ask a question may press star and 1 on the touchtone telephone. The next question is from the line of Abhishek Singhal from Perpetuity Ventures. Please go ahead.
Sir, thanks for taking my question. I had just a couple of questions. Number one, if you can please highlight a bit on the Yash Pharma acquisition. It's been almost a year. How did it go? Are you happy with the integration, the way it's playing out? Going forward, like how is the integration playing out? Some sense around like a 12-month view post the acquisition. And any learnings that you think you can possibly take from that in the future acquisitions that you do in the domestic pharma space?
Yeah. So Abhishek, I'm surprised you came in so late in terms of your question. So happy to be here. So I think Yash Pharma was the first acquisition or the only acquisition that JPL has done thus far. While I'm personally exposed to multiple acquisitions, it was a great learning for this organization because acquisition is not about one person. It is about the entire organizational capability has to come up. And I believe as a company, we have done extremely well in this acquisition management and post-acquisition management specifically. So the transaction or the business that we acquired is doing well for us. It is growing. It is the faster growing business within the organization. The profitability, which was roughly half of JPL level, has now come up to JPL's level, and that's why you'll see that there is no dip in our margins. In fact, we continue to be on a reasonable track of margins now. And so also the working capital and all that. In spite of this acquisition, our working capital hasn't gone up. So all in all, we are extremely happy with this acquisition strategically. and more so in terms of organization capability building that we have achieved. See, today it gives me greater confidence to go and acquire something going forward and taking a bigger step compared to what I would have done earlier. Because it was not about me, it is about the JPL capabilities. And with Amrit and Nirav joining, I think that capability has also gone up furthermore.
And sir, is the gross margin now for Yash Pharma in line with what you had anticipated? Like, because earlier you were talking about the fact that we have to get the back end sorted out here to some extent to get the synergies in place.
Yeah. So Yash Pharma, historically, that business that we acquired had a lower gross margin because of the nature of product. They are predominantly a liquids and cream organization with hormonal manufacturing that JPL, hormonal products that JPL had. Margins are tracking well. We are able to improve a bit, but my guess is a lot more will be done in the future. It's a journey, and we do believe we have the largest scope in gross margin improvement within the organization, both at Yash, largely coming out of Yash Pharma portfolio.
Got it, sir. Thank you. Sir, and just if I kind of broadly construct the growth, the three elements to it, one is volume, value, and then new product introduction. Now, when we acquired it, it's been 2-3 years since then. New product introduction was supposed to be brought into place, which can kind of drive growth. So some highlight into where the journey currently stands. How are you looking at, the launches forward in terms of number of launches or specific categories, more in terms of line extension? So the new product introduction segment of the potential growth, if you can highlight a bit more, like does it entail investing more or possibly in licensing from somewhere? If you can provide some light on that element as to what to anticipate going forward there.
So I'll answer a bit of this and then I'll have Amrit to respond a little better. But see, if you look at this 3 years, you have to split it in two parts, because when we acquired Jagsonpal, there was a great product happening at that point of time for JPL, which was dydrogesterone. Okay, that product became from 0 to 40 crores in about 18 months' time for the company. And last 24 months is when that product has gone back from 40 crores to 10 crores. So what has happened is, while overall our growth is lower, or what you see as growth for last 2 years is lower, a lot of it is because of the significant underperformance, which is strategic by us. That decision was taken by us given the way that market changed. And that 30 crores eating away into the growth of other products is showing up in terms of final outcomes. So it's not that other new products and all are not doing well. Can they do better? Answer is yes. But unfortunately, they are not able to compensate for the hole that we got from dydrogesterone over last 2 years. So that has been kind of moderating our growth. Dydrogesterone experience, we are also very cautious on our new product launch, wherein we do not want to get into potentially crowded areas. So just to give you an example, while me and Amrit are still debating, but we do not intend to launch like a GLP-1 on the date of patent expiry, because we know 80 guys will be there on day one. So our new product launches are always going to be in more difficult categories where we have to do concept selling. Therefore, the build-up will be slower but more sustainable. Amrit, can you add to this in terms of how you look at new product strategy and how do you want to drive this going forward?
Thank you so much. And suffices to say two things which you would have possibly understood from the discussion so far. One is we have a very high skew of some of our pillar brands or large brands, legacy brands, which contribute significantly to the revenue. And therefore, there is a fine balance which has to be brought in while we build up our new product portfolio. There is a limited time constraint in front of a doctor. So we don't want our large brands to get compromised in front of doctor promotion, which we have very time constrained. At the same time, building a new portfolio which is more vibrant and is growth oriented. So that work is on, and while we are curating that list of new products for future, we will possibly disclose that, or you will come to know when the commercial launches happen or we are close to that launch. I hope that answers you.
Thank you very much. Thanks for your time.
Thank you. Participants who wish to ask a question may press star and 1 on the touchtone telephone. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you all participants for your valuable questions and engagement today. We appreciate your interest in JPL. Should you have any further queries or require any further additional information, please do not hesitate to contact our investor relations team at Go India Advisors. We remain committed to engaging with you all. Thank you once again for your participation and wishing you a great day ahead. Thank you.
On behalf of Go India Advisors LLP, thank you for joining us. You may now disconnect.